This video covers the income statement. The specific sections are the users of the financial statements, particularly the income statement, the formats and sections of the income statement, net income and its relationship to stockholders' equity, discontinued operations, non-controlling interests, and earnings per share. Let's start with who cares about the income statement. Who are the users of the financial statements? The primary users are investors, also known as stockholders or common stockholders, shareholders, or owners. The reason that they care about the income statement is because they're trying to estimate what the stock price should be. And stock price is typically the estimate of all future cash flows. And sometimes accountants tend to think that those cash flows could be replaced with earnings, or earnings per share, instead of simply cash flows. Estimate of all future cash flows or earnings discounted to current dollar terms. The other main group of users of financial statements are the creditors. Two main types of creditors. The one biggest type is the lenders, those who actually give cash to the company, typically banks, bondholders, those are the big ones. There are other types of creditors, suppliers, employees who are owed their wages, the government that's owed its taxes, anyone that didn't directly provide cash to the company but is waiting for the cash repayment from the company. There's two main types of formats for the income statement. The single step format we see here, and that single step reports all revenues together at the top of that income statement and all expenses together below the revenues. So we can see here that interest revenue and gain on sale on investment has the same importance. It's shown at the top of the income statement as sales revenue. In the single step statement, one equation is used. Total revenues minus total expenses equals net income. Most companies, however, use the multi-step income statement, and that the multi-step income statement distinguishes among the various activities that affect net income. In addition to the net income, it reports other totals, so we don't see just one equation, but multiple equations, and typically it reports subtotals for gross profit, sales revenue minus cost of goods sold, operating income, or gross profit minus operating expenses, non-operating income or loss, then income before taxes. And of course, following income before taxes, the next total would be your net income. Here we see the multi-step income statement for American Eagle's Outfitters, and we see, as expected, total revenues, cost of goods sold is indicated as cost of sales, gross profit. We see our operating expenses as selling, general, administrative, impairment, depreciation and amortization. We see a subtotal for operating income or income from operations. Then we see the non-operating items. We see income before income taxes, income tax expense, and then finally net income. Let's briefly discuss revenues versus gains and expenses versus losses. Revenues are recorded when goods are sold or services are provided to a customer. In other words, when the company is doing whatever it is that it's in business to do. Gains, on the other hand, refer to the recognition of an asset, often cash or some sort of receivable, not directly related to the company's primary business operations. Think about the gain on the sale of a building. The asset that was received was cash, and it was greater than the book value of the building that was sold. So this is going to increase the company's net income, but it's not directly related to what the company's in business of doing, assuming it's not a real estate company. Expenses versus losses. Expenses are costs that benefit the current accounting period. typically help the company produce revenues. Some examples of expenses: salaries expense, cost of goods sold, income tax expense. Losses, on the other hand, do not relate to the company's primary operations. For example, think about the impairment of inventory. Inventory decreased in value because of something that happened either in the market or something that happened to the company's specific inventory. It wasn't necessary to run the business, but it's something that happened to the company and reduced income. Operating expenses relate to the primary activities of the company. They are the expenses that are necessary for the company to run its business and produce revenue. We see obvious examples here: advertising expense, bad debts expense, depreciation, amortization, rent, salaries and wages expense, R&D. Oftentimes, we see operating expenses grouped into one of two categories, and sometimes these two categories are reported together: selling expenses and general and administrative expenses. And as we saw before for American Eagle, we saw selling, general, and administrative expenses lumped together. Non-operating revenues, gains, expenses, and losses are not related to the company's primary activities. Examples include interest expense. These are the results of the company choosing to finance with notes payable or bonds payable, some sort of a long-term debt. Gains on sales of long-term assets, such as plant, property, and equipment, investment securities, intangible assets. Losses on sales of long-term assets. Let's put gains and losses on sales of long-term assets. Impairment, and we see the value of an asset decrease. Impairment might be on inventory, and other long-term assets such as PP&E, intangible assets. And another one that we see fairly commonly is restructuring charges. When a company changes the way that it's set up, oftentimes sells a part of its business, lays off employees, or takes a turn in exactly how the business was going to run. And finally, on the income statement, income tax expense is reported towards the bottom, below income before taxes. Let's review the relationship between net income and stockholders' equity. Remember, at the end of the period, net income or net loss is transferred to retained earnings. Retained earnings, of course, is a component of stockholders' equity. Net income increases retained earnings and therefore increases stockholders' equity. A net loss, on the other hand, decreases retained earnings, stockholders' equity. Remember that dividends do not affect net income. When the company declares and pays dividends, cash decreases, and the other side of that entry would be a reduction to retained earnings, and therefore reduce stockholders' equity. Another item we might see on the income statement relates to discontinued operations. Discontinued operations are reported when a component of the business is either held for sale, the company plans to sell it, it is sold during the accounting period, or during the accounting period it's somehow disposed of or abandoned. This disposal, whether it's held for sale or sold or abandoned, must represent a strategic shift, meaning something like a major line of business is discontinued, or something as significant as a major geographical area is discontinued. Think of a company that does a lot of business in Russia in the past year or year and a half, it's decided it's no longer going to have sales in Russia. That might be, that component might be considered a discontinued operation. Here we see, I've pasted in Dell's most recent 10K, and we can see our typical income statement format until we get to income tax expense. Below that, rather than seeing net income, we see net income from continuing operations. And then we see a line for income from discontinued operations. We can also see that this is going to be further explained in footnote number 3. When a company reports discontinued operations, we see here the line net income is changed to income from continuing operations. The results of discontinued operations net of tax are reported as a separate component of net income. Below income from continuing operations. So why does GAAP have us do this? Why does GAAP say that if we have discontinued operations, they're going to be reported in a separate line? Well, if the company sells or disposes of a major component of its business, the performance of that component is not going to affect the company's future performance. And remember, the main users of financial statements are those investors, and they're using the income statement to help predict future performance, or to put it a different way, to estimate stock price. So if a major component of the business will no longer affect the company's future performance, it's not going to affect stock price, and the investor might want to see the performance from that discontinued component separately, so it can decide, does it want to put less weight on that performance or perhaps no weight at all when it's putting the information into its valuation model. If a company has discontinued operations, it must report earnings from continuing operations on a per share basis, the net gain or loss from discontinued operations, on a per share basis. That can be reported in the income statement or in the footnotes. It also needs to report the net amount, net income per share. Another point to remember is that both basic and diluted earnings per share, which we'll talk about in a moment, are reported for income from continuing operations and separately for the discontinued gain or loss. Next, we move on to non-controlling interests, often referred to as minority interest. Remember the rules from when we covered this in intermediate accounting. If a company, we're going to refer to the company as the parent company. This is the reporting entity, the company whose financial statements we're looking at. If it owns more than 50% but less than 100% of the common stock of another company, the parent combines its own financial statements with those of the subsidiary. And reports a consolidated, in this case, income statement. And that's why we'll see down below from many of the financial statements we look at, we see the title not simply income statement, but consolidated income statement. And here I've pasted in the most recent 10K for Verizon. And if we look at Verizon's 10K, we see in the income statement, we see below net income, we have a line for net income attributable to the non-controlling interests, and then finally the net income attributable to Verizon. The portion of the net income that does not belong, so we've consolidated, we own, let's say, 60% of our subsidiary, but we've consolidated 100% of their revenues and 100% of their expenses. The parent consolidates all of the revenues, expenses, and even though it does not own 100% of the subsidiary. And the portion of the net income that does not belong to the parent, because it does not own 100% of the subsidiary, is called the non-controlling interest. or the minority interest. And this amount, it's subtracted from consolidated net income. So what we see here, our formula for that we're going to see on the income statement, we're going to see a consolidated net income below that provision for income taxes. And then we're going to subtract out net income attributable to the non-controlling interest. And what we're left with is this income attributable to the reporting entity. This is going to be typically the last line on the income statement. And this is also the amount attributable to the reporting entry is the amount that is going to be used in earnings per share. Let's move on to earnings per share. And let's start with basic earnings per share. So when you look the definition of basic in Urban Dictionary and you see, OMG, Bae is so basic, all she wants to do is drink pumpkin spice lattes and play Candy Crush. Or when you see the meme of Kamala Harris saying this is so basic, obviously what they're talking about is basic earnings per share. We see the formula for basic earnings per share here. Net income minus preferred dividends divided by the weighted average common shares outstanding. Basic earnings per share refers to earnings per share assuming that the company has no securities that can be converted into common stock. And if the company actually does have securities that can be converted into common stock, we ignore them when we're calculating earnings per share. We make this calculation assuming that the company only has common stock and may have non-convertible preferred stock. The numerator, we have net income available to all common stockholders. If there's a net loss, obviously that would be negative, and the preferred dividends would increase the loss in the numerator. The denominator refers to a number of shares. It is not the total dollar amount of stockholders' equity. And since the number of common shares outstanding often changes throughout the accounting period, a weighted average, which accounts for the portion of the year that each number of shares was outstanding, is affected by any of the following items. One, of course, the number of shares in the beginning of the period. What did we start with? Then if any additional shares were issued during the period, that's going to increase our weighted average common shares outstanding. This is going to increase the weighted average shares outstanding, or I'll call this the denominator. If the number of shares issued increases the denominator, what would decrease the denominator is if shares were purchased back, bought back from investors. So the number of shares repurchased, bought back, or purchased as treasury stock. These are all terms meaning the same thing during the period. This would, of course, decrease the denominator. And then finally, stock dividends, stock splits, put more shares into the hands of the investors, so they would increase this denominator of the weighted average common shares outstanding. As the number of weighted average common shares outstanding increases, earnings per share, of course, will decrease. Issuing additional shares or a stock split is going to obviously decrease earnings per share. And a share repurchase, since it decreases our denominator, it will increase earnings per share. So investors need to keep this in mind when they're looking at the income statement. This is kind of a simple way to be able to manipulate the earnings per share number. If a company reports consolidated net income, the net income amount used in the earnings per share calculation is income attributable to the reported entity, not the consolidated net income. How about a diluted earnings per share? At the bottom of the income statement, a company reports both basic earnings per share as well as diluted earnings per share. Let's start with what a complex capital structure means. A company has a complex capital structure when it has securities that can be converted into common stock and would therefore increase that denominator in our earnings per share calculation, which would therefore dilute, or simpler terms, reduce the earnings per share of common stock. If the holder of an instrument can convert that into additional shares of common stock, our denominator in the earnings per share calculation increases, and therefore the earnings per share decreases. We consider the potential dilution or reduction of common stockholders' interests in the company's earnings when we calculate diluted earnings per share. So what are these complex capital structure items? What are these securities that can be converted into common stock? Three common examples are convertible preferred stock, convertible into common stock at the discretion of the holder or the investor in the preferred stock shares, convertible bonds, bonds issued by the company that allow the bondholder, to decide if and when they want to convert those bonds into shares of common stock. And another common one is stock warrants. These are a good example of stock warrants is employee stock options. The company gives these options to the stockholder. At the stockholder's discretion, they can decide they want to exercise that option and turn it into shares of common stock. All of this is going to affect, if any of these actions took place, it affects earnings per share. Diluted earnings per share doesn't need these holders of the convertible securities to actually convert them into shares of common stock. Basic earnings per share ignores potentially dilutive securities. And diluted earnings per share is the amount of income that's available to each share of common stock outstanding during the period and to each share that would have been outstanding. So it didn't actually get converted, but could be. Would have been outstanding, assuming the issuance of common stock during the year for all potentially dilutive securities. Again, the denominator in the diluted earnings per share calculation is the weighted average number of common shares. Assuming, if this didn't really happen, we assume that all dilutive securities were converted into common stock during the year. It didn't actually happen, but we said, what if that happened? Diluted earnings per share is a worst case scenario approach. What if every holder of a security that can be converted into common stock had converted those securities during the year? What would be that worst case scenario impact to earnings per share? That's what we're told. That's the answer to the question with diluted earnings per share. And finally, diluted earnings per share will always result in a lower earnings per share number than basic earnings per share.